Hey, this is Tom, and in this video I'll explain to you why Cathie Wood and ARK Invest just purchased 1.2 million shares of Palantir. There's not a lot of secrets here. It's a great company, but she has a great reason, which I'll show you here using a full DCF. Yes, I'm going to do a full DCF on Palantir. You'll get to see it step by step because that DCF is basically critical to me showing you why Cathie Wood loaded the boat on Palantir just last week. And she was not the only one. A lot of institutional money is flowing into Palantir recently. In fact, companies like BlackRock, Vanguard, a lot of the big hitters are putting more and more money into Palantir. The institutional holdings of this company have doubled in the past 4 months. And the pace is only getting stronger and stronger. Now, out of those 1,100 institutional shareholders in Palantir, you know how many of them are short? 22. Literally 2%. 98% is long, 2% is short. Now that shows you everything. Nobody in smart money is actually shorting the stock out of these crazy 22. I don't know what's, probably wrong key, or maybe the cleaning lady went over the keyboard. I don't know what happened, but essentially, nobody's really shorting it. Now, the real question is why all of this institutional money is flowing in, why Cathie Wood, which actually holds about 5% of the institutional float, 32 million shares, she holds about 5% of the entire 700 million float. So the question is, what the hell is going on here? Now, in this video, I'll show you why using even the most insanely absurd conservative assumptions, Palantir is still grossly undervalued, and why if you're in institutional money with some patience, that's a good entry point for you. If you look at a company, you say, well, this company is outperforming, it's growing nicely, the management is good, it's getting revenues, free cash flow, and the stock price just ain't matching up because of different reasons like macroeconomics, fear of interest rates, or basically, just general FUD like they had with Tesla for a couple of years. If that kind of disconnect exists between the share price and the company's performance, usually institutionals look for an entry price. But because they're patient and because they're not idiots, they'll wait for a sweet spot. And I think that's what they're seeing right now. Essentially, at $16, $16.5, they're basically saying, well, it's going to be very hard for us to lose money on this stock if we get in at 16.5 if we have patience. Because as I'm about to show you right now, even with the insanely conservative assumptions that I've used, there's still 50% upside from 16.5 all the way up, even if you think the company is total garbage. And, if you have a good deal like that, a lot of institutionals will jump on it, which is exactly what's going on. Let me show you on the computer. Okay, so this is my DCF, 2022, 2027, 5-year DCF. Revenues are based on a 30% annual growth based on the company's guidance, which I think is sandbagged. I think they're intentionally giving a low estimate of 30% annual growth, but we'll use it just to keep it conservative. This is the cost of goods structure for the next 5 years. Selling, general, administrative. Now, if you look at the historical numbers, you'll see that this actually is lower than the SG&A in 2021 and 2020. The reason is that 20 was also loaded with SBC, stock-based compensation, that kind of artificially inflated SG&A. And if you look at years without this SBC, basically before the DPO, which by definition created a lot of SBC, and before Alex Karp got his new badge for the next 10 years, you'll see that it's around 700 million. So we use 750 and we give it a nice little bump every year. Also, we have R&D expenses right here, which is in line with what the company is doing. And now we can talk about the EBITDA. So basically the result is this EBITDA right here. And as you can see right here, we use a 21% tax rate. Now, this is insanely conservative. Over the past 5 years, the company lost a lot of money. They've accumulated a lot of losses, which they can carry forward to years where they actually have profits. Because if we add it up, we get about 11.5 billion or 11 billion here. A lot of it will be offset against the many, many years of losses the company accumulated over the years. So not all of this will be paid because, as you should know, a lot of forwards can be done with losses. Losses can be carried forward to years in which you have gains from previous years in which you lost money. And God knows Palantir lost a lot of money. So this is another ultra conservative assumption. As you can see right here, we have CapEx assumptions of 200 million over the course of the next 5 years, which is, again, a joke. It's insane. Palantir is not going to even invest half, not even 1/4 of this number. It's not a company that has a lot of CapEx. It's a software business. They don't really invest in buildings and machinery and stuff like that. The expense is basically R&D and salaries. So this is just a crazy assumptions, just to go crazy here. a 10% discount rate, and as you can see right here, a 4% perpetual growth rate right here. And at this point, you should also pay attention to this number below. The net debt is 2.2 billion, a lot of cash, very low debt. As you remember, this was intentional by the company. And if you calculate all of this, you get two numbers. The DCF value is 44 billion, and the EBITDA multiple, which should be 25, we used 18 here just to be conservative, will give you a nice 55.1. The average will give you 49 billion.6, which is 49.57% higher than the current price of 33 billion and 200, which the company is currently trading at. So even if you apply the most conservative assumptions in history, completely go ballistic on this company, it still has 50%. It's pretty much free money for these institutionals, and they're literally picking it up from the ground. And you'd be shocked how simple the formula for this is. Basically, great company, panic selling equals money. Simple as that. Now, all of these institutionals will be quietly buying as the price is dipping. All of the retail investors are going to be shaking, their balls are going to be shaking, their arms are going to be shaking, they're all going to be paper handing out of the stock while these guys quietly move in. This is exactly what's going on here. But then again, not everybody is built for a 2, 3, 4 year holding period, even though they say they are. I mean, this is what the stock requires. If you don't have the stomach for a couple of years of losses, at least virtually, stay away from this. Now, if this was helpful, let me know below. Also, try to take my calculation. Completely go crazy with it. If you can make me look like an idiot, post it in comments. I'm not going to delete any comments. If you can basically confirm what I said here, go crazy. If you want to make a little bit more of a, aggressive assumption, let's see where it gets you. In any case, this DCF calculation will be available to download in full for you to play around with on our Patreon page. If you want to join, it's $5 per month, and if anything, you'll get the success spreadsheet, but you'll also be a part of our community. You'll be supporting the channel, our Zoom calls, the updates, everything, the Discord. The link is in the description and in the pinned comment. I'll see you there, hopefully, in a minute. Later.